Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. You know, it's hard to tell if this market's dying or if it's thriving. The swings are so big these days. You know, what's going on? Well, we've got some data that we want to share with you that will probably help you get a better idea of what's going on. So let's dive into this video.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Bob, this market seems so bipolar. Today we're up 1.5% in one day. What's going on?
Yeah, so big volatility moves, big intraday moves are bearish. So bull markets grind and bear markets are spastic. And what's happening here is that there is such a desire for the Fed to pause and to pivot. They're trying not to sell the market off because they don't want to be put out of a position then, and then the Fed pauses and then people miss the move. And really what's happening here is that they're signaling to the Fed that they're not being effective enough yet. They're not being restrictive enough yet because there's still this speculation that's out there, even though it's false speculation, because as we know, we talked about here, is that most of the action now intraday is the 0 days to expiration option contracts. And underneath the hood of the stock market is that's falling. In fact, you know, we've had customers today, and even you mentioned somebody that you know personally, that the stock market is showing itself up, right, from what you see in the headlines for the year, but people's portfolios that are being professionally managed are down. And so there's a bifurcation here, and it's starting to get people nervous that, like, hey, why does everything look like it's up every day when it's really down in my portfolio? And then when that happens to people, especially when you get these gyrations like we're getting in the market, is that people will start to say, just take me to cash, or hey, I can get 4.5% in the bond market, and I just don't need this aggravation of one day up, one day down. And as you know, Phil, you and I, we swing trade and you trade futures and do stuff in the Forex, is that it's almost impossible to swing trade now. You get a big move up that kind of confirms to you, okay, I got to swing buy, and then you enter that trade, and the very next day they take you out at your knees. And depending on how you have your stop set up, you end up getting small cuts of losses if you do this. So we're kind of refusing to play that game. We're waiting now for stocks either to really push down and catch it on a rebound back up, or just stay away from the market and short the high flyers. And I just want to show you guys a chart of how insane the market is. So check this chart out. This is just a sample of what we're seeing intraday, is that you're getting these moves. And yesterday, I think we had 7 moves that kind of swung on a pivot up and down. And today we had 3 moves swinging on a pivot up and down. It's because the market, and you put it pretty well today when you're talking to our people in the room, is that every day is its own ecosystem. It's like the market doesn't know what tomorrow is, doesn't care what tomorrow is. It's what can I get away with today? And the ironic thing about it is, you know, we're down for the week. It just today looked like, oh my gosh, this is a new bull market, but it was simply a reaction to somebody saying, well, if it was up to me, I'm going to pause, and he's a non-voting member. But all it took was the algos to hit it and then scared people out of their short positions. But companies like Tesla didn't even react to it. Bitcoin didn't react to it. The metals, the miners, the energy stocks that are the strength of the market didn't react to that. But the top 10 most shorted and biggest market cap stocks reacted to it. And that's all they cared about, is how do I profit for today? And I'm going to go, you shut up for a second and just kind of get your thoughts on this, because you're trading futures. So you're kind of adding and subtracting into your position. So kind of maybe share a little bit of what you're thinking and what you're doing.
Yeah. So when, if we rewind to last month when we were telling everybody, look, the liquidity is going south, and that continues to be the case. We're going lower and lower on liquidity, which means that these market prices are actually what we would consider at euphoric levels, even still now with these moves. And when we were at that point several weeks ago, that's why I was saying it's time to be short or hedged. So you can take out, a futures position basically to hedge, either go cash and go short futures. But if you're long stuff, right, you can go short futures or longer term put options as well. There's a couple different ways you can do it. But for me, the way I manage this volatility is, okay, I got that position up there, higher up above 4,000, right? And holding that core short position until the breadth says that we're overdone to the downside and fair value at least comes back down to par, right? Because right now it's still over 300 points. So where this market likes to bottom out, especially if we're in a larger bear market rotation that's turning down, you're going to get back to par on fair value. So the problem is that intraday, you get these 1.5, anywhere from 1.2 to 1.5% swings. This was a snapshot, and today actually was 1.5+%. I'm not sure I even saw that quite during the COVID month of March 2020, where we saw exactly the same market action, which scares me because that's a market that ended up crashing down. And like Bob said, bullish markets grind higher every day. Not a ton of volatility. It's just relentless buying week in and week out, grind. This swinging up and down over 1% is when the market's breaking, okay? And especially when we go through what I call areas of transition, you get this real big zigzaggy movement, and then it rolls back over once it punches through that range. And then you have like a really strong trend move down. So I'm basically just looking at when we get these large rotations up 1.5%, I'll add. So if we get a large drop, let's say 1.5% drop, especially if we hit a level that I'm looking at, like say we get to 3,900, take some off, get the big 1.5% move up, add some back on. And that's the easiest way to play this without getting too caught up in just like, oh my gosh, the market's just ripping higher. And what that does is that prevents you from shorting the whole. So if you look at this chart, what you don't want to do is be at the bottom of those V reversals. And what's happening is people are piling into those lows. So you see what the game was being played here. Every time we make a new low, what happens? They rip it up a percentage point, right? And so that's what you have to look at. You have to look at this market, not that you're going to be catching a move that continues, but rather they're trying to inflict the most damage on both sides, okay? And this is probably the best I've ever seen it at that. Like they're at the top of their game right now. They're cleaning out the shorts, they're cleaning out the longs, and they're going to continue to do that. I think ultimately we puke up and we end up capitulating to the downside because when you get this type of volatility, it always ends up blowing out to the downside. And then it finally washes out. We get a period of calm, and then we probably start grinding, back up into a more healthy trading environment. But for me, to explain how I'm doing it, basically core short position and then adding on the very extreme edges, which if you look at this chart would be after a day like this, adding back on. Because these moves in this market, especially when they're like 1% moves straight up or over 1%, they're unsustainable. There's just because the liquidity is going away. So you're having all of this like up and down, but meanwhile, you're on the escalator going down. So it's like you're playing yo-yo on an escalator going down. You just don't want to be at the bottom of that yo-yo throw, right? Going short because they're going to rip your face off. And that's what's happening here. It's sad because people are getting killed. Not only is their portfolios going down, but when they're trying to do and trade intraday, they're getting killed because I think they're missing the picture here. And you got to like zoom out on the chart. You can't be just like nose to the tree here and looking like a 1 or 2 or 3 minute chart. Like if you're not looking at the bigger chart and like, okay, we just took out a major swing low, you're just going to get killed. And I think that's where people are making a big mistake in this market.
Yeah, people tend to be late.
Yeah.
So you agonize and then you're like, oh shoot, I'm missing it. And it's called FOMO, and FOMO kills you.
Right.
But I think there's something secular happening here too, Phil. So in 2014, Ben Bernanke kind of announced the Great Moderation, and this volatility cycle that we're starting to get into is really ending that great moderation. And this is why, I'm talking to people. Look, we'd love for you to use our trading service if you want to. We'd love for you to listen to our podcast. But if you're getting your portfolio professionally managed, you're in what's called passive funds. They just buy the indexes depending on your age and your risk profile. The success of that is ending. And what's going to happen now is people have choices. They're gonna look more at fundamentals because the market's kind of breaking apart. You notice energy's doing fine, shippers are doing fine, tech's at a death rattle. That you get these big wild moves and it's not consistent lifting of the sector. Financials are in trouble, home builders are in trouble, real estate's in trouble, auto market's in trouble. So there's a lot of basically inconsistencies across the board. You got to be in the right sector and the right stocks in the right sector. So active investing is going to become the norm again. And if you don't want to screw off any of that, you just get 4.85%, stick your money into a treasury for 3 months and give yourself a mental health break.
Mm-hmm.
And I think a lot of people are starting to see that. And that's bad news for the banks too. So because the banks are going to run out of liquidity, which exacerbates all the things Phil talks about with liquidity. And then people are in big trouble. And Phil, you want to read the quote from this thing too? Because I think it makes perfect sense.
Yeah. But it says, with inflation at multi-decade highs and interest rates at their highest levels in over 15 years, some investors are saying that the old investing epoch has come to an end, ushering in a new era where fundamentals matter, traditional savers are rewarded once again, and the volatility that Bernanke said goodbye to is back. So in other words, choppier waters might be the new norm for a while.
Yeah, we're seeing it. We're seeing it intraday, and then we're going to start seeing it intra-week, and then we're going to start seeing it intra-month. It's going to behoove people to get closer to their portfolios because there's going to be tremendous opportunities out there. I know, the way that YouTube makes us be doomy here on our titles, but when you have tremendous stress, there's tremendous opportunities. And, we're not talking about like things happen today. Most people didn't even know the market went up 1.5% yet, but I'm talking about when this market flushes out here in the next probably 30, 45 days, there's going to be a nice probably 4 to 6 week move higher, and then it's going to cycle down again. It's going to give people tremendous opportunities to make a lot of money, even if the market is consistently moving down, which it will do in a high inflation environment. We will lose 40 to 50% from the highs until this pain trade is over, but it's going to be over multi-months, and you're going to have many months where the market's going to be up 5, 10, 15, 20%. So I just wanted to share this with you guys, and that you have to start really paying attention now to what's going on versus just, hey, I got this thing professionally managed, because there's a lot of very disappointed professionally managed portfolios out there right now.
Oh yeah, 100%. And I can see it too. I mean, the mutual fund statements come in and they're down, and they seem like they're down more than they should be relative to the market, because the market, Q1, right? We'll see in our statements, but Q1's been positive. People are looking at their monthly statements going like, there's a disconnect here, because like you said, the basket of what those guys are focused on isn't reflecting what the index is doing, because the index is heavily weighted in these little meme stocks that are just, everyone's piling into like the last city of refuge here, right? But I think what you saw today in Tesla, Bob, where completely disconnected, like you said, even Bitcoin was fairly muted. I think you got to look at those clues, because they really leverage tech, right, in this market to kind of pull everything higher. And I think tech was showing the hand a little bit as far as the lack of liquidity. That's really the issue here. And so, yeah, you're going to get these big gamma squeezes like this chart shows you here. Wait till you get like at least closer to a 1% move before you think about maybe shorting or selling something in this market right now. That seems to be working out pretty well. But until we see like the liquidity flows come back up, and they will, but that might not be till the latter half of March, let's say. And then you get that typical push up into May, so you can sell in May and go away. And then, and that's actually where after May is where I'm a little concerned going into the middle of summer, where we could have a significant market low. But as long as we're keeping an eye on that and tracking it and knowing that, hey, that's probably the turn that's coming, we can be prepared. So just keep tuning in, join us in the room. And I think you'll do pretty well with navigating this market, because it's probably as volatile. Well, for me, Bob, and I've been doing this for about 15 years on the stock side of things, and it's probably as volatile as I've ever seen it, even through comparing it to like the '08 and COVID crashes.
Yeah, it's weird because the cognitive dissonance on this is amazing. We knew 2008 why. We knew 2020 why. Here, it's like they're telling us two different things at the same time.
Yeah.
And I think it's not gonna end well. So. No. I really appreciate you guys listening. Definitely hit like, hit subscribe, hit notification for all of them. Check out Phil's newsletter. It's pure profit. It's great stuff in there. And I think you really enjoy his daily read on this. It definitely pays for itself. It really, really gets you understanding the structure of the markets. Even if you don't trade futures, it's going to get you on the right side of trade. So check them out. Links are below. Have a great day.
Thanks, Bob. See you guys.
Trade Genius.